But one thing that you look at from the stock market perspective, even with all the negative headlines, stocks actually tend to do pretty well during a government shutdown with an average 3-month return after the shutdown at 9.5% and 1 year later at 22.4%. And to bring this up, not necessarily to encourage you to think that you'll get a 22% return this time around because the valuations on the stock market these days are so crazy, but just to show you that it doesn't really have an impact on the stock market. That is the reason that we provide these numbers. Not to say, again, you're going to get 9.5 after 3 months and 22% after a year. But again, it doesn't really move the needle because many times the stock market looks through it. They know that maybe it's a month, maybe even it's 2 months. It's going to get resolved at some point.
But look at not just these numbers, but it should give you some good feelings here. But unfortunately, bonds, I was surprised with this, don't do as well with a 3-month return being a negative 37% and a 1 year return on bonds being a 10.7%, a minus 10.7%, not positive. What this means is during a government shutdown is generally long-term interest rates increase as bonds fall. And this would be a detriment to the housing market because why? Well, housing market, they're going to have problems because what will happen is that if bonds fall, rates go up, mortgages go up. So that's going to hurt the mortgage market and it's going to hurt the housing market as well.